Hi, today is September 10th, 2011, and I will be interviewing Mike Fratantoni. He is the SVP and Chief Economist of the Mortgage Bankers Association. I'll be right back.
Good.
Okay, great. So let's start with what I just saw, which was astonishing, the Mortgage Credit Availability Index, which looks like the only time it was really lower was during the Great Recession. Can you talk a little bit about that and the implications for that?
Sure. So I think you got to connect it to the broader crisis. We saw the unemployment rate jump to the highest level since the Great Depression,
Yeah.
and millions of people lose their jobs and lose income, and just tremendous amount of uncertainty about sort of what the future is going to hold, about ability of the economy to recover. And so I think anytime you see that kind of an economic downturn, you're going to see credit tighten. And we did here. We've seen it across the board to some extent, but what I've highlighted is that it's tightened most on either end of the spectrum.
Mm-hmm.
So for first-time buyers who might get an FHA loan, we have seen particularly significant jumps in delinquency rates for FHA loans, and that has led many lenders to become more cautious with respect to credit terms there. So they might put an overlay requiring a higher minimum credit score, for example. So that's one place where we've seen tightening to a great extent. But it's interesting that the other end of the market, for jumbo borrowers buying expensive homes with very large mortgages, we've also seen tightening. And the reason there is a little bit different, where before the pandemic, most jumbo loans were being held by banks on their balance sheet, and so there was just a little bit of private label securitization. That private label securitization essentially stopped at the worst part of the pandemic.
Mm-hmm.
And banks have so many competing demands for their balance sheet that they really tightened up criteria on any bank, on any loans they were going to hold, and that included jumbo loans. So,
Right.
One thing we highlighted in the release of this August Credit Availability Index was, further tightening in the jumbo space, where for someone looking to buy a home, there is certainly jumbo credit available. Terms are pretty tight. But for someone looking to refinance, or particularly get a cash-out refinance, it's gotten very, very difficult indeed. So
Oh, wow.
those are sort of the opposite ends of the spectrum in the mortgage market. If you look sort of right in the middle of the market, someone getting a conventional loan, going to Fannie and Freddie for a home purchase, terms haven't changed very much. You've certainly seen credit tightening for cash-out refinances, and particularly for higher balance loans going to Fannie and Freddie.
Mm-hmm.
But I think your typical, first-time buyer getting a conventional loan, or sort of moderate income homeowner moving up to a larger home, that credit is available.
So how do you think this is going to affect the home purchase trend in general? Because, the prices have remained really high, and in fact, in cities, they still seem to be largely unaffordable. So how do you think that this new tightening of credit is going to weigh on maybe home prices? Now we have three different, well, we always did, but I guess we have to discuss it: suburban, urban, and rural markets.
Right. So when I was thinking about the housing market for 2020 coming into this year, we were really optimistic and very confident it was going to be a strong year for home sales. And the reasons were really threefold. One, you had at that time a strong job market with the unemployment rate lowest in 50 years. Two, you had very low mortgage rates. And then third was just we have this very strong demographic tailwind right now, where you have the millennial cohort rapidly getting close to peak first-time home buyer age. And this is just millions of households that are at the age where they're looking to buy a home.
Mm-hmm.
And that was the case before the crisis. Then, worse of the pandemic hit in March and April, and we saw purchase application volume, which is a good leading indicator for the market, dropped, and we were as much as 35% behind last year.
Wow.
At one point.
Mm-hmm.
But states reopened in May, and we saw the housing market come roaring back, and purchase application volume was, as much as 20% ahead of 2019 by midsummer, and now it's running 40% ahead of
Wow.
2019. So the credit being tight is obviously not impacting overall purchase demand.
Right.
I think it probably is, as I said, constraining if it's a first-time buyer with, less than perfect credit who is looking to get an FHA loan, that buyer probably is constrained. Or if it's a person looking to get a jumbo loan to get a higher-end home, that person is constrained. But there are so many of these millennial buyers right there in the middle of the market that is supporting the housing market to a great extent. And honestly, we're more worried at this point that there's just not enough inventory on the market, that whether you look at existing homes or new homes, you're talking of 3 or 4 months of supply at the current sales pace. And builders, have picked up pace of construction. We've seen starts and permits recover, but there still are just not enough units on the market to support the underlying demand that we believe is there, because the demographics are still very favorable. Mortgage rates are now even lower. Obviously, the job market is not what it was, but just based upon our data and what we're seeing elsewhere, there are enough people out there who have jobs that have not been directly impacted by the shutdowns and are able to maintain their income. And not only are they able to make that step to buy a home, but that they got enough confidence that they're going to be able to maintain that going forward. So
What do you think? Do you see?
we are very optimistic about the purchase market in the next couple of years.
Even given the high unemployment numbers, and the high FHA 15.65% delinquency numbers. And also, we haven't talked about this, how much is forbearance and eviction moratoriums kind of keeping things a little bit maybe masked rather than, what they really are. I mean, there are a lot of former Airbnb hosts who have people who haven't been paying them because of the eviction moratorium. There are a lot of people who haven't been able to pay their mortgage, and they are they're not being foreclosed on at this point.
Yeah, so those are certainly data that we provide to the market, and we've been watching very closely. So absolutely, we've seen this spike in delinquency rates, and we are sort of go to great pains to point this out very carefully in our delinquency survey data, that if someone's in forbearance but don't make a payment, that's going to be reported as delinquent in our national delinquency survey data. Mm-hmm. That's a different sort of task than what the CARES Act required, which is that if someone's in forbearance, they don't get a negative impact on their credit report. So the credit bureau data would not show them as delinquent. Mm-hmm. But we're showing it as delinquent because we want to really illustrate sort of the cash flows that are or are not occurring. Mm-hmm. And from an industry standpoint, if the borrower doesn't make that payment, the servicer has to make it on their behalf, at least for a time. And right. So we want to track those servicer commitments as well.
Are the servicers, go ahead.
I was going to say, so you got it exactly right. At least as of second quarter, we saw this spike in delinquencies, particularly for FHA borrowers. Mm-hmm. We've also, on a weekly basis, been tracking the forbearance rates. And, that peaked for the total market in middle of June, and since has been coming down as we've seen, almost 1 million households exit forbearance just with, in many cases, because they had been making payments even while in forbearance, and now are in a position where they're able to resume their normal payments again.
Interesting.
But we've highlighted the last couple of weeks that there definitely is a different trend. So for the Fannie and Freddie portfolio of loans, that forbearance share keeps dropping and dropping relatively steadily.
Mm-hmm.
For the pool of loans made up of FHA and VA loans that are securitized through Ginnie Mae, that's begun to increase again.
Oh, no.
So I think to your broader question, I'm much more worried that some of these borrowers who are in the FHA or VA programs who, go into those loans with somewhat weaker credit, less money saved, are just a little bit more tenuous in terms of their hold onto home ownership, much more worried about sort of what happens 6 months, a year from now if the job isn't recovered, because I think those are the borrowers more at risk of those delinquencies going to later stage delinquencies after they leave forbearance. I guess I'm much less worried about that going to foreclosure in the current environment, just because there's such a shortage of inventory. I think many households will be able to sell if they needed to, and you wouldn't see that show up as a foreclosure. It would be a sale, but they still wouldn't be able to maintain their home, which is very sad.
Yeah. And maybe why we're seeing those very elevated numbers in intergenerational housing. I'm sure you've already seen this, that new Pew research that showed 52% of 18 to 29-year-olds are living with their parents. This is the highest since the Great Depression. Any comment on that?
I did see that, looked at it briefly. I guess my main question is, and this is a little bit, your own life informs these conversations sometimes, are those college students who are at home? So I know my own college student has been home since March. So I don't know whether how the study would consider that versus someone who made a decision to move back in because of a housing situation. But this is certainly an environment where you see people doubling up.
Yeah, and I guess that's also leads me to, should we talk a little bit about the flight out of the city and maybe into the suburbs? I know before, I kind of divide my time between New York and Santa Monica, and when I was in New York in March and April, the buildings were empty, and it wasn't just the office buildings, a lot of the residential buildings. If people had a summer home, they moved. And if they had parents, they moved in with them. So we were seeing this huge, vast amount of buildings that were vacated.
I think it's one of the most important questions coming out of this crisis, and it's going to be really, really difficult at this point to really nail down any conclusion. So I think something that was happening the last couple of years, well before the pandemic, is again this group of millennials moving from early 20s to late 20s into their 30s. You naturally would see them leave the cities and move to the suburbs, as they're having children looking for schools, et cetera. So I think that was happening anyway. Mm-hmm. And sort of now the question is, with the pandemic and concerns about urban conditions, is this just another reason on the list to move out of the city? And so will we see that happening in more and more places? Yeah. And, the folks who've tried to use data to address this question thus far, at least when I've reviewed what folks have done, in most parts of the country, it's kind of tough to tell whether this really is an additional factor or whether it's just a continuation of the new trend. And I would say that is with the exception of New York, because I think New York was hit so hard in March and April. It's that some flight from Manhattan is happening. Although it's interesting, I was reading something just in the past week from someone who lives there, and there was a view that it really was just essentially some of the higher end neighborhoods within Manhattan, that it's not Queens or Brooklyn, that are being impacted by that decision. So for folks that have the ability to go to a summer home, sure, that is happening. But for the vast majority of New Yorkers, that this is not a reason to leave New York. But again, I think it's early, but it really is an important thing to watch because,
Yeah.
the last several years we've seen a lot of, higher end multifamily apartments being constructed in many of the larger cities with an anticipation that people would want to stay. And that was very much on the thought that people have gotten used to and appreciate a lot of the urban amenities, and we're going to
Yeah.
stay in an urban lifestyle even as they got older. But we don't know. We don't know to what extent this experience may really change the direction and make that a more complex situation.
And work from home. And I saw some statistics that the spike in homes for sale in San Francisco was like 90% year over year or something crazy too. So it seems to be not just New York, maybe. And another thing that these cities have in common is the high costs of housing. If somebody is going to have to pay, more than 30% and sometimes upwards of 50 or 75% of their income to live, and they can move to the suburb and it's more affordable, that's another factor as well. Do you have any comment on that?
So absolutely, the need for more affordable housing has been an increasingly important topic the last couple of years. From our perspective, we really see it as an issue of constrained supply. Mm-hmm. And so to the extent we can get more building in cities, in suburbs, in rural areas, we kind of need it everywhere. I think prior to the last crisis, there was a bit of a preference for more of really sort of the ex-urban outlying areas in many metro markets. That doesn't seem to have returned with the same level of intensity as was true 10 years ago. Mm-hmm. And it seems like, to your point, more of the demand is either urban or in suburbs, maybe sort of transit-oriented development. So that becomes more challenging from an affordability perspective. And, like every household along a number of dimensions, they got to make trade-offs between, what they're spending for cars and transportation, what they're spending for schools, what they're spending for housing, et cetera. And, perhaps as a result of the pandemic, you're going to see people making different trade-offs, right, with respect to how much space they want, how much independent mobility they want, et cetera, right? So I think those are the natures of the trade-off. But, in a situation where we don't have enough housing stock in the country, prices are going to stay high. And, this is an area where we've had a bit of a different view from other forecasters, thinking that home prices are likely going to keep going up. So even though the unemployment rate is high, we just think the mismatch between still strong demand and constrained supply is going to keep home prices increasing even next year as we exit from this pandemic.
Interesting. We can talk about price rule later, but how about let's get into commercial real estate? Because this is obviously something that is greatly impacted. And it also leads me to talk about malls, because there has been a long crisis in malls, and some of the malls had turned to commercial real estate transition projects as their kind of Hail Mary. So can we talk about both commercial real estate and also office malls? Malls, yeah. Retail malls.
Yeah, certainly. So when we think about the commercial world, it's absolutely, to your point, it really is different stories by different property type. And I also think it's different about the short to medium term versus the longer term.
Yeah.
So with respect to malls and overall retail, it's been on a downward trend for years. And what we're seeing with the pandemic really has just accelerated what was a decline in demand for in-person shopping, with a lot of that transitioning over to e-commerce. Mm-hmm. And some retail spaces and some malls had really made a bet that maybe it's experiential retail, which will save them all. So move away from, department stores and do more gyms and restaurants and theaters. And unfortunately, that really hasn't worked, given the particular nature of this crisis. So I think, folks that made heavy bets there that might have made this situation even worse.
Mm-hmm.
If you look at the flip side of retail, the e-commerce, that's really driven enormous demand for industrial space, whether warehouse or logistics facilities that e-commerce operators are using to try to get closer and closer to their customers. So in some cases, you're even talking about folks converting some of those malls that are not being heavily used into sort of last mile distribution centers. And so we're seeing the industrial sector strong both in the short term and the long term. The third property type, office buildings, I think exactly to your point, in the short term, these are long leases that companies hold, and they're not going to quickly adjust how much office space they're using. So not really seeing any enormous swings in the office market thus far. But it is a big question for the long term of, to what extent is widespread remote work going to persist after the crisis, and to what extent are companies then going to reduce their demand for office space? So, a real question on the longer term.
So you
then
think
when you
that,
look at,
yeah,
go ahead.
when when we talk about this, I mean, the logistics of returning to work in the short term are nightmare. I mean, I was talking to Howard Silverblatt, who, as you know, is probably the senior index analyst of S&P 500, and he said that you would have to wait maybe an hour because in order to get up to your office building, especially if there was, 60, 70 floors, they're only allowing a very limited number in the elevator, and then having everybody's desks 6 feet apart is going to reduce the occupancy, which of course increase the cost dramatically. So I'm wondering about the short term as well as the long term, and then you have to factor in all of the technology companies that are saying, hey, we really like this work from home thing. Some of them are saying it's going to be pretty available for the majority of their staff, and others are saying, well, at least 50%,
Yeah, I agree. I guess my sense of the short term versus the long term is more from the property owner's perspective versus, or the lender's perspective, where they're still seeing office rents coming in most cases, right? And so the decision for them then comes when those leases end and the company is making a decision of whether to extend the lease or not, and how much
so they won't
demand is
break
there
it.
for that space.
You don't think that?
If the company fails or goes bankrupt, then potentially, and you're seeing that in the retail space, but just not hearing much about that in the office space, at least thus far. Hopefully that'll continue. But yeah, totally agree that all the logistical and operational aspects of particularly high-rise office is going to be very challenging. Then the last property type that we really focus on are apartments. And even though we are seeing this strong demand for home ownership in the single-family mortgage market, you're seeing rental payments hold up pretty well. This is the National Multi-Housing Council data, really holding up better than people had anticipated. And that's where you would expect to see really the impact of this elevated unemployment rate. Maybe it's still too early. We are worried that the failure to extend the enhanced unemployment insurance benefits, really could show up as lower rental payments in the apartment space, but not seeing it yet. And then long term, again, with a shortage of housing stock broadly, that's going to support apartment markets as well. And then just
Right.
the absolute final spot, which is just really challenging, is the lodging and hotel sector, which is just getting crushed by this crisis. And longer term, you don't know to what extent the travel, business conference, et cetera, is going to go back to where we were prior and how long it would take to get there. You certainly hear about the airlines and others really concerned about sort of any, really the lack of any rebound thus far. And so I think the hotel sector is one of the worst hit by this crisis by far.
And you think that the mid and long-term outlook are just too hard to guess because everything is so highly dependent on the course, how this pandemic rolls out, right?
Right, and then just psychology around whether business or leisure travelers, whether they're going to feel comfortable getting back on planes again.
Or even if
And,
they have to.
Right, and getting to those conferences, though, I mean, that was such a part of,
Mhm.
so many hotel business models was serving that conference audience, and it's very challenging to see that go away.
Especially, I mean, I think people have become more accustomed now to just attending things online, whether it's a board meeting or an office meeting or even a conference that have gone online. People have, I know I had to move my whole business online and I found out it was easier.
Definitely, there's a lot less downtime if you're just hopping from one virtual meeting to another, isn't it? I mean,
Yeah.
so much of that travel time was difficult to be productive.
The other thing I think is really important here is how much of the data is being masked by, again, the forbearance and also eviction moratoriums. I know you've made it clear that your data is not masked by the forbearance, but the eviction moratorium, are we really able to get good data on who is in trouble when we can't evict anybody until next year?
Well, I think that's a different question, right? Because I think the National Multi-Housing Council rental data is about rents coming in. And if you think about it, an eviction really is the very end of the process, and totally makes sense that you don't want to push people out of housing during the midst of a pandemic.
Mm-hmm.
But a lot of what our thinking has been is you need to support the rental household. It's not a question of, once they've fallen behind, preventing them from being evicted. That's a little bit too late in the game. And it's much more important, either through stimulus payments or the enhanced unemployment insurance, or through direct rental assistance to help them pay their rent, as opposed to after they didn't pay their rent, prevent them from being evicted, which then just transfers a problem which was a rental household problem into also a landlord problem.
Yes.
And to sort of kick the can down the road. So I think the eviction and the foreclosure moratoria, again, from a public health standpoint, make a lot of sense, but I think it's not correct to think that they're gonna solve a problem or even mask a problem. I think it's just really delaying what and sort of transferring that problem onto another actor.
Yes, absolutely. I mean, I have heard from, we get more anecdotal because we work with personal finance, but I have heard from a lot of landlords that are really concerned about it because they're in forbearance on their own mortgages because their tenant, whether it's a short-term Airbnb tenant or a longer-term tenant, is not paying. And but you're saying the numbers are not heightened on what you're saying yet.
That the rental payments are still coming in, but we have just been strongly supportive of Congress, the administration, extending particularly the enhanced unemployment insurance benefits, because I think particularly it's rental households that have benefited the most from having that support.
Okay. I know we're kind of ending my time here with you, but I had a couple more quick questions. Are you worried at all that we've just been put on a negative outlook from Fitch on our AAA USA status?
So I did see that, and S&P downgraded the U.S. What was that, back in 2012 or so, around
2011
debt limit issue. And I'll always remember sort of the way they wrote about that, which was something to the effect that I'm paraphrasing, but it was, we don't have any doubt that the U.S. will be able to service its debt, but this is not the way a AAA country acts. And that just really stuck with me because it just does speak to sort of the challenges in our governance process right now of sort of, reaching sensible compromises and making sure that, any additional spending decisions that we're making are made sort of sensibly with the view to the future. All that said, the U.S. remains an incredibly strong country and reserve currency for the rest of the world. And so I don't have it, again, to echo what S&P said, have no doubts that the U.S. will be able to service the debt, but the fact that the debt to GDP is the highest has been since World War II,
Yeah.
we think that is going to put some upward pressure on interest rates over time. And I think the Congressional Budget Office has done a great job of really illustrating, just how intense that's going to be, where, in just a few years, we're going to be spending as much on net interest as we are on defense. And
even with the promise of low interest rates from the Federal Reserve.
Yep. Yep.
Now, that is one other thing, because the mortgage interest rate can move slightly differently from the Fed fund rate. So what are you seeing in short, mid, and long term? Even though the Feds have said, basically they've said, as you know, I mean, I'm not telling you anything, but our listeners, that they're going to keep interest rates low, even if inflation starts to show up, because they, they're targeting rather an average inflation rather than a number. So, but how can that possibly, can interest rates on the mortgages start rising based on other impetus? What do you think is on the horizon?
Yeah, so the Fed directly controls an overnight interest rate, the federal funds rate. And, as you said, they've essentially promised to keep that at zero over the next couple of years. Mortgage rates tend to more closely track the 10-year Treasury rate. And the 10-year Treasury rate, to your point, is going to capture investor expectations of future issuance to support the deficits. It's going to capture investor expectations of future inflation. So we think, because of these large deficits and this incredible amount of debt the Treasury is going to have to auction, that there will be some upward pressure on 10-year Treasury rates and mortgage rates as well. So where today, we're closer to 3% for a 30-year fixed mortgage rate.
Yeah.
We think that'll be closer to 3.5% next year. So it's not an enormous increase. Prior to this year, that would have been a record low.
Right.
But we think it'll be higher than it is in 2020, and then go up from there. And would not be surprised if 2-3 years down the road we're back above 4% again. So again, not historically high, but certainly higher than we are today.
Yeah, and for someone that's going a little bit further out on the price based on the lower interest rate, especially if it's an ARM, that could be very significant.
Oh, definitely, yeah. If you're getting an adjustable rate mortgage today, really much more likely that rate's going to go up at reset than down.
So if you're one of those lucky people that are able to refinance at this point, lock in the fixed, is that what you're saying?
That's what we're seeing people do, right? I mean, the ARM share in our recent data is about 2%.
Wow.
98% of borrowers today are choosing fixed rate loans, and that's in line with historical patterns, that when fixed rates get extremely low, people opt for a fixed rate.
What was the ARM rate ratio in the Great Recession?
The share?
Yeah.
Yeah. So I think the number to highlight is, back in 2005, which was sort of the peak of the ARM market, the ARM share was 35% at its peak.
Wow.
But more typical will be a 7 or 8% ARM share. But as I said, in recent weeks, it's been in the 2% territory.
Okay, so This will be kind of like the last theme, just to get your 2 cents on it. It's less about the mortgage environment and more about just general, since you are an economist and you have been around the block a few times and you were involved in the housing industry during the Great Recession. What lessons have we learned from the Great Recession that maybe this time we're going to do better in terms of policy, my guess mostly?
Right. So I think the forbearance plans that are in place now really were well thought out, in the sense that back in the Great Recession, there was a lot of work trying to document and precisely identify exactly which households could qualify for what types of modifications under what types of terms. And it was a tremendously frustrating process for borrowers, for lenders, for everyone involved, because it really just tied the system up in knots. And the approach this time was different, and it said if a borrower had a hardship related to COVID, they got forbearance. And then coming out of forbearance, there's going to be a small handful of options that I think should be relatively easy for servicers working with their customers to make sure they quickly get into a exit from forbearance where that's going to be sustainable. And so I think we're going to be spinning our wheels to a much less extent than was true in the Great Recession, which was just a miserable time for anyone involved, which left really a lot of lessons learned, and I think those have been applied well here. I think the other thing,
yeah, go ahead.
I was going to say, just the other thing just to keep in mind, though, is just this environment is so different from a housing market perspective, because back in 2009, we had this enormous overhang of supply on the market, which led to home prices nationally dropping more than 20%. And as I said, this time the problem is not enough homes. So that decline in home values left millions of homeowners underwater, unable to sell their homes, unable to refinance, and it just led to years of just challenges trying to get the housing market back on its feet. We're not in that place now. We still have a shortage of units. Home prices are going up. There are certainly going to be households that are really going to struggle because they've lost jobs, and definitely need to work with them to resolve that in the best means possible. But this is just not the housing market crisis that we had 10 years ago.
I think there's a number that I hear very few people talking about, and that is one about the amount of homes we have that are actually severely underwater, which is 3.4 million. So what we're hearing from homeowners is that if they were doing a loan modification, a lot of times what's happening is that they are getting a payment that they can afford, but all of the fees and missed payments are packed onto the back end. And so they are now paying off maybe an $800,000 home with a loan that's now 1.2 or 1.3 million. So do you have anything to say about the underwater mortgage market?
Like I said, I just don't see that as a large number of households at this point, given that home prices have grown for the last decade, and given that we expect home prices to continue to grow into next year. Don't see that as being the same issue as it was in the Great Recession.
Okay. Do you want to say any last thing about GSE reform or the health of those entities at this point?
Oh, I think to do that justice, that would take another 45 minutes of your time. So
you can give us a cliff note.
Pause there.
Okay. All right. Thanks so much for your time. I really appreciate it.
All right. Thanks.
Bye.
All right. Thank you.
Goodbye. Thanks a lot, Adam.